Good afternoon, everybody. Welcome to TraderMerlin Show for your Wednesday FOMC announcement day. Hope you're all doing fantastic. Pretty much everything went in line with expectations as we came out with the PPI numbers and the CPI or PPI and Fed announcement data today. So I'm going to talk about that to start. If you read my little write down, Yoki, I want to know what you're doing and what are you doing in Guangzhou, China? What are you doing over there, bud? So today I'm going to talk about obviously the latest stuff that Jerome Powell talked about. We'll look at the FOMC, we'll look at the charts, we'll look at the PPI numbers, and then I taught class last week in Irvine for Online Trading Academy, and so I think something happened with my computer because and nobody noticed it yesterday when I talked about markets hitting all-time highs, and I'm like, oh yeah, the S&P, that would be the line was drawn at 5,028. I'm like, we haven't even broke 4,900 on the S&P. So what happened was, if you do an adjustment, unadjusted versus adjusted charts for futures, it can completely skew the data. So I noticed that after the show yesterday, and Chad also sent me an email saying, hey, I think you're making a mistake there. I'm not sure how that got checked, but I will show you that big difference in data. And if you guys are using futures platforms, there's always this debate that goes on between traders between adjusted and unadjusted charts. I personally like mine unadjusted. I don't want to accommodate for the rollovers. I just want to leave it as is and give me that pure price. It's a better price in my opinion. So, all right, let's get going. Oh, but yeah, Ken, I know I've got the facial hair. That's a change of pace. Haven't decided whether I'm gonna chop it all off. Oh, cool, good. Well, glad you get to reunite with your wife. It must have been a while. All right, so let me look at the Jerome Powell announcement for today. So, of course, you guys all, I'm sure, know the announcement. They kept everything right where it's at, which was, as we talked about on yesterday, a 98.4% chance of that happening. However, I went through here and I basically download normally I listen to the whole thing and I type it out, but I was just too busy today, as I've been really busy lately. I downloaded all of the pre-made remarks and just to find anything in here that's noteworthy. So I'll walk through some of this stuff. Obviously, they're patting themselves in the back about inflation. It says inflation has eased from its highs and has now come this has come without significant increase in unemployment rate. That to me is a very interesting one, and it's a good one because we've talked about their dual mandate: stable prices, which is inflation, and full employment. So with those numbers, which have been slightly rising, I think they find themselves in a good place. So we go here to go to Forex Factory. I will bring up the PPI data for today and the FOMC announcement. Here is your chart of the PPI data that came out today. So that came out right at 0, in line with expectations and showing, very good sign because we have no growth on producer price index. Now, we talked about the unemployment rate. I thought this was rather interesting. One of the things that economists are always trying to do is trying to anticipate where is something going to go. Let me check my points in here. The median unemployment rate projection in this Statement of Economic Projections, which is the SEP, rises somewhat from 3.8%. Now, what do you guys think? You may not have heard it or listened to it, but I'm just curious what you guys think. If we are currently sitting at 3.8% unemployment, if we go out a full year from now, do you think unemployment is going to be higher or it's going to be lower? Just curious what you guys think. Of course, it doesn't really matter. It's just all conjecture at this point. It's just the facts at the end of the year, next year, will be what is ultimately true. So I thought it was interesting because they said they expect it to be, based off all the consensus from their members, we're going to go from 3.8% to 4.1% at the end of next year. I thought that was a little bit stretchy. I think you actually be higher than 4.1%. You think it'd be lower, Margaret? Wow, you guys say lower? I mean, that means that we are just loaded with jobs. I mean, historically, we've looked at this chart before. Let me bring up last week's unemployment data just so I can have that one for you guys, and we'll check that out just so you can see historically where we go. Here's the unemployment rate. So right now we're at 3.7%. Here's the chart of that, and let me just go back all the way to as far back as this will let me go. It looks like 2004 is as far back as this will let me go. And you'll notice if I put my cursor on these recent lows, the lows that go back in 2019, we were at about 3.4, 3.5. Like, that is historically ridiculously low, even through robust times back in here in 2014, 15, 16, when things were looking really good. We were still up at 4.5%, 5%. Now, if I scroll back even further here and go all the way to 2000, we were at 3.8. So really the lowest point that you're going to see on this chart, going back the last 23 years, is 3.4. And that was during this low point here in 2019. So all in all, I don't know. I find that a little bit hard to believe that we're going to stay this low. If you look at the recent moves in the unemployment numbers, you can see here we've just slowly started to tick back up. I, for one, think we will be higher by the end of 2024. Maybe we'll do a poll on different economic data. I know I do every year a poll on the S&P 500 to see where you guys think it'll be by the end of the year. And right now, I don't think I'm anywhere close on that. We'll find out here in a couple of days when we do our final year wrap up. Most of you saying lower. Joe says about the same time, same level, same with Ricardo. Gilbert says depends on who the president will be. That will certainly have an impact on it. But remember, the president's not going to be elected, and the election doesn't start until November. So I don't know if that necessarily is going to have a dramatic impact in the 2 months after the election. So I think the end of year 2025 will have a dramatic impact on who's president. And remember, what will typically happen is the current administration will do everything they can to make all these numbers look rosy for next year. Cook the books, make unemployment numbers stay low, right? That's one incentive for them to keep it low. They can look back and go, see, we have historically low unemployment rate. Under the previous administration, it was much higher. Yeah, well, because we had COVID. But I think that the election will impact the 2025 much more dramatically. Maybe there's some anticipation at the end of next year, but I think it was probably going to be based off the economic data and window dressing by the current administration. So we shall see at the end of next year how it all pans out. I think you're going to be slightly higher. I'm thinking more like 4.5%, but they say 4.1. One other thing I noticed in here, he says, as I've noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. And I keep making the point that's got to get filtered through the system. He also says, and we have decreased our securities holdings by more than $1 trillion. I didn't pull up the stats to show exactly what the size of the Fed's portfolio was right now, but if you think about that, that's $1 trillion of assets that they have unloaded on our markets. So perfect timing. When do you find sellers for things? When do you find buyers for things? When the markets are really strong. As those markets are moving up, you sell into that momentum, and the Fed has been blessed because we've had a pretty robust market, and they've been out there selling assets in a nice uptrending market. Things are strong. We'll see if they keep doing that. He did cite that they're going to continue selling assets on their balance sheet at a brisk pace. So we'll see how long it takes for them to get to $2 trillion. The other part in here, I usually write my own notes, which makes it a little bit easier for me, but I thought it was interesting when they talk about inflation is still being too high. It's not that substantially high. I mean, obviously the energy numbers have caused inflation to drop significantly over the past 6 months. That's what's looking so great right now. Their feeling is that we're still too high with regards to inflation. If you annualize our current rates, we're probably looking somewhere around 2.8, 2.9, depending on which metric you're looking at. And remember, their target was 2%. So all in all, we're pretty damn close to getting their 2% target. Now, it says recent indicators suggest that economic activity has slowed substantially from the outsized pace seen in the third quarter. I don't know where they're getting that data from. If we go and look at some of the other economic data, let me go out here to Forex Factory. I'm going to go to calendar, and we will just show you the U.S. data. Hey, Big M, good to see you. I'm kind of surprised at that announcement there from Jerome Powell. Let's get out of speeches. We don't need miscellaneous. We don't need consumer surveys or business surveys. Let's get rid of those. And now we can just go back the past couple of weeks and see, which major data. So obviously the jobs data is still fine. There was a little bit less job creation last week with that ADP non-farm employment change, and unemployment rate's 3.9. So that's still robust. We go back to the last week of November, and we look at Case-Shiller Composite 20 Home Price Index. Home prices still rising. That's a very positive piece of economic data, even though Jerome Powell cited that it wasn't. We've seen, while we had those 4 months of down moves and contraction in price with regards to Case-Shiller Composite 20 Home Price Index, we look pretty damn good right now. I mean, our previous number was 3.9%. It looks like we're back to an uptrending surge in price, and that may be largely due to the decline in that 10-year bond. We've seen that 10-year tank significantly, and that could have a big impact there. What about our GDP? Well, I mean, you look at the GDP numbers, it looks to me like they're growing. So I don't know where the Fed is making this statement where it says recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace in the third quarter. He says, even so, GDP is on track to expand around 2.5% for a full whole year, bolstered by a strong consumer demand as well as improving supply conditions. So I feel like this was a curveball that Jerome Powell threw us. Here's your GDP numbers, and I mean, all in all, this looks pretty good. Kind of surprised that they're citing bad economic data. And maybe what they're trying to do is throw a little bit of shade on the market so they can make themselves look even better when the data finally does come out. But, housing data looks fairly decent. Existing home sales has slid. All right, so you're still seeing a downtrend in existing home sales. That's, not a great sign. Of course, the cheaper that we get our 30-year fixed rate mortgages, the more likely we'll see those numbers start to surge. So that's one piece of bad data out of the 6 I've just cited. You have durable goods orders. That's bad, right? You can see the big contraction here in durable goods orders, but let's be honest, this is not like a smooth trending item. Durable goods orders is volatile and all over the place. One month it's a huge contraction, next month it's a big expansion. So I don't put a lot of emphasis on that durable goods orders, which showed a negative 5.4% contraction on the previous reading. Now, I'm going to just do November. I won't go all the way back to the 12 months. Don't worry. Retail sales numbers. All right, we go to retail sales numbers. This is the one that goes back to November. We could probably look at the most recent one, which is going to happen Thursday. We get tomorrow. Retail sales not looking so great. You could go here and show the past, let's say, 8 months to a year. We were doing really well, and all of a sudden, for the month of November, things contracted. And I think that has a lot to do with all the big sales that were being done before Black Friday. I think that the dynamics of market behavior are changing because of the way that we're advertising and the sales go on. I'll leave it there. I think that the economic data actually looks pretty good, and Jerome Powell is out here citing bad economic data. I'm like, where are you getting that from? And you notice that he mentioned it, but he didn't say what data. I really would like to hear them say it's this piece, and this piece that we're looking at. So one other part here, in our summary of economic projections, the committee participants revised up their assessments of GDP growth this year, but expect growth to cool, with the median projection falling to 1.4% next year. 1.4% is not good. That's not a good growth number over time. So maybe that's the piece that he's focusing on. Anyway, all in all, was pretty damn good today for the announcement. Let's check out what happened with our markets. I'll bring up the S&P here. Let's go SPX. And let's just do this on a 5-minute basis so you can see when that announcement came out. Not only did it surge during the initial announcement, right as it was released, but once Jerome Powell started speaking, we got a second leg of momentum to the upside, all in all, posting some very good numbers for the day. So let's start at the bottom, work our way to the top. Your worst performer on the day, dollar index. No surprise there. As soon as they came out with that announcement, you could see dollar index just falling significantly here. So dollar's losing a little bit of its luster against those other securities in that basket, including predominantly the euro, which is over 50% of the index. Now, I'll zoom out a little bit here so you can see what was happening before. And this is, again, why we stay away from markets as those announcements happen. Because if you're on the wrong side of this stuff, you're going to get absolutely smoked. Dollar was down 0.85% today. Now, if we look at the bigger term picture here of the dollar index, we talked about on yesterday's show how even though I think long-term dollar is fine, we've got this shorter-term trend started back in October, lower lows, lower highs. I expect it to continue to drift lower until it breaks and makes a new high. So there we go. Lori, I hope all went well. Hope it all went well for you. Here's your 10-year on the day. Now, it shows your 0.1% gain, but keep in mind, that is the new session. We've rolled over into Thursday's session on the 10-year bond. Notice the move today, though. If you go from the close of yesterday's price to where we closed at today, the 10-year was down 4.35%. So this is great news for home buyers. This is great news for economic expansion. He did cite in the speech that he saw a slowdown in business expansion. And of course, we talked about the cost of capital. Bond prices being so high, borrowing money becomes cumbersome for businesses when rates are that high. So all in all, things looking good. Our head and shoulders, we're going to have two really good head and shoulders patterns this year. We got that one on the Russell, which hit perfectly to the T. We may get that same kind of impact here on the 10-year. We might get right down to that level, right around 3.95%. It's kind of where the projection line based off of that head and shoulders pattern should hit. So all in all, things are still looking good for further downside move on that 10-year. Again, if we continue to move down on that 10-year, equity markets are going to move up. And you saw some real nice move up there today. What is going on here? This is not right. Let's look at IWM, but these charts get all wonky, especially right around rollover time. We get really weird numbers, so let me fix that one. Okay, gold. Oh, I'm bummed. I'm really bummed on this one. I had a number set on GLD to buy gold. It's still in the system. I've got an order in there. I was going to sell some puts, but decided just to buy some gold outright because I do like gold long term. And today we came so close to my zone and then bounced out of that one and ripped to the upside. So gold 0.21%, even though it was much higher over the course of the day, it had a real volatile intraday price to it. There you go. We were sideways and all of a sudden screamed up. I'm not sure why my chart looks so broken on the daily time frame here. But all in all, gold looking great on the day. Here is your 1 day. Let's look at GLD because for some reason this chart looks messed up. I'm not trusting my data right now. Yeah, there you go. It didn't pull back. So for some reason that futures chart is showing a big contraction, which was a way bigger up day. And I knew it wasn't right because silver on the day is up like 4%. Gold was 2.2%. So all in all, there we go. Is gold the inverse of the US dollar? Margaret, there's an interesting correlation between those two. It's not necessarily that it is totally inverse, but yes, historically there is an inverse relationship between the two, although it deviates. Now, one great resource, I've mentioned this one before. Let me see more research. MRCI. I think this is it. MRCI, puts out a table. If you want, I can put this one in the chat for you guys. I know I've done this one before, so here you go. All right, so there's your the chart. And you asked about the dollar. You said, is gold inverse to the USD? So we can just go here to the DX, which is dollar future, and we'll go down here till we see GC. Scroll over, and it looks like right here, it's 62% inversely correlated. So right now, over the past 180 days, gold is inversely related to the dollar to the tune of about 62%. So there you go. To answer your question precisely with statistics. Robert says, why is the curve still inverted? Well, it's still inverted because you just saw the long-term bond yields are falling and the short-term yields are staying the same. Remember, the Fed controls the short end of the yield curve. So the short side hasn't been dropping. The long side has. So we can go here to another resource for you guys. Thank you, Sly. Like. If you go to dynamic yield curve. Sorry, I tried to type that one at the same time. You go to dynamic yield curve. Stockcharts.com has a very interesting yield curve that's animated. Sometimes I'll type an animated yield curve, but you click on this dynamic yield curve tool. I've shown you this one before. It's very cool because you can still see the issue that we have. So to answer your question much more clearly, where did that one go? Robert, if you look here, the short end of this is still controlled by the Fed. So that's why, notice it's still stuck way up here, but as we go forward, the maturities start to, the longer we get dated maturities, the yields are falling. And that 10-year fell even more today. You had like a 4% drop in the 10-year today. So to me, that is pretty important. And the more that we see those 10-year yields drop, the more this is going to be inverted. Now, if we look at the inversion chart that we've been talking about, and I've been showing you here, here is the 10-year and the 2-year. This is what most people are looking at, right? If we look at the daily time frame here, I mean, this thing is still dramatically inverted. It's been inverted going all the way back to July of 2022. So we're a year and a half that we've been inverted on this thing. I don't know what the final outcome is. I know that an inverted yield curve is not good. It tells you that there isn't a lot of faith in the long-term prospects for the markets. However, we've also never seen it inverted this long. A year and a half? I mean, that's a tremendous amount of time. I don't know what the impacts are, and I'm sure we have academics that could tell you, when it's inverted this long, it does this and this and this. I don't know if I necessarily buy that. I just know it's not good, and I keep thinking that there's going to be some troubles ahead, but we seem to be sailing through it without too much damage. So all in all, even though we're this inverted, still looking okay on the grand scheme of things. Of course, based off of Powell's presentation and speech today. So yeah, we are still inverted to the tune of about 40 basis points on the 10 versus the 2. Of course, Bill Addis will tell you it's really about the 10 and the 1, which is almost a 1% difference. I mean, it's just crazy to think you could buy a 1-year bond and be making a full percentage more than, almost a full percentage more than the 10-year bond. So just strange to me. And here's your 30-year bond. We've seen those yields drop significantly, just almost 1 full percentage point since October 20th. That is one of the major catalysts for the market. We've never printed this much cash either. Absolutely. You know, that's one thing it's one chart I love showing people, and it just makes them just go, what? Oh my God, I had no idea. You just type in M1 money supply, and the first thing will come up is a chart by the Fed. There's the Federal Reserve. You click on M1 money supply. This is cash, checking accounts, savings accounts, right? I mean, all of a sudden you have more money ever in cash. And this is the crazy part, right? We went from, in 2020, there were $3.9 trillion worth of cash in the U.S. markets. Cash. And we peaked out in May of 2022 at right around 21 trillion. So that means you put $17 trillion worth of cash into the market. This is probably in my lifetime will be the most unbelievable chart I've ever seen. And we still have not, at least in my opinion, still have not felt the full pain of doing something this dramatic. Just crazy. Big Ed says, short-term T-bills are still decent. Yeah. I mean, heck, I'll take 5% for 3 months. Now remember, that's annualized. That's 5% per year, but you lock that in for 3 months. It doesn't mean you're making 5% for 3 months. Just so you know, that'd be 20% per year. I'd be buying those bonds right now. Okay, so we've gone on a few tangents here, and we've gone from our bond market to looking at yield curves to looking at correlations between gold and the dollar index. Let's keep it going. Is the Fed's plan to remove all that cash? Great question. Do you guys think, let me do a poll. All right, let's just do a little poll. I'll start a poll here and say, can the Fed remove $17 trillion? I'm going to do a little dollar sign there. Without hurting it, yes or no? There you go. Can the Fed remove $17 trillion from the markets without hurting it? Remember, the whole purpose of this was stimulus. They put so much money in there, it's a stimulus, making sure that the markets are supported, that businesses were supported, that businesses had access to cheap money, that you got your $1,200 stimmy checks. All that stuff has just been printed, not just by the Federal Reserve and the Treasury Department, but also mandated by the government. So, to me, you try to pull that rug out from this market, it's going to have a dramatic impact and could really hurt it. Now, the good news for all of us is you'll notice on the hard rate, let's just zoom in a little bit because it's pretty dramatic when you look at it from that perspective. You notice that we've actually started to slowly reduce, right? They've gone from a peak of right around 21 trillion, and currently we sit at about 18 trillion. So they've taken almost $3 trillion out in the last year and a half, almost 2 years. To me, that's an astounding achievement. Will they be able to take the full $17 trillion out? I don't think there's a chance in hell that's going to happen. If they pull all that money out, it's going to have an impact on businesses and economies and cycles. You take that money out of the equation, all of a sudden businesses are like, hey, wait a minute, we needed that to kind of prop ourselves up. So I don't think there's a chance in hell you're going to get all of it out. Let's see what the poll says. Poll says 90% of you said nope, 10% said yes. Okay, I don't think they can take out the full $17 trillion. I think they might be able to whittle it down, maybe get out another 6 or 7 trillion from current levels. But getting it all out of the system, keep in mind, it's in the system. It's like saying you've injected someone with morphine, you're going to go in the blood supply and try to take that out. Well, some of it's going to dissipate over time. I think that the Fed is going to try to take some money out, and they're going to keep on dropping until they get to the point where they see economic impact. So this chart that you see here, they'll be removing more and more over time, slowly drifting down lower. We'll see how much they can get out. And maybe by the next couple of years, I think it'll take them a couple of years to get down towards those levels. But I think our days of being at $4 trillion worth of cash in the system is long gone. I think we'll probably maybe get down to about 10, which would put us right about, where's 10? Right where my cursor is at. If we got to 10, I think that'd be a really aggressive target. Most likely it'll be somewhere around 12 or 14 trillion dollars total in the system. But they're not going to bring it all back down. No way. Let's see. Is that why meme stocks rallied? I don't know why meme stocks rally, Robert. Meme stocks are just pump and dump for fools. They get lucky with them meme stocks. Who knows why the hell they do what they do? That's Reddit, Wall Street bets, pump and dump, stuff like that. So that's an area I don't play in because I'm not that kind of speculator or gambler. All right, let me keep moving up our list here. I was on a roll. We made it to gold. Let me just look at silver's chart today. Check out SLV, guys. This was a huge move up today. I'm a fan of this one. I wanted to sell some more silver puts. I was waiting for a little bit more down move. Didn't get it. That's fine. I'll stay with my current positions. As you know, I have calls against my position at 22.50 and at 23. This could be working out perfectly. I mean, in a perfect world, I'm going to close at 22.49 on silver on Friday, and then I'll sell my $24 calls against it on that following Monday, and maybe even higher depending on what happens. So all in all, I love what happened with gold and silver today. Now we start with the indexes. Here's your NASDAQ. NASDAQ 100 futures. I'm actually going to go to the ETFs for this, guys, just because I think they're a better reading. You have contract rollover sometimes creates really wonky, weird moves, so I'm just going to do that. Tom says they can reduce M1 when we return to better policies and energy taxes and regulation. Sure, right. And what you're saying right there is kind of why I don't think it's going to happen. Do we think that we're going to get a unanimous consensus by both sides of the aisle on energy, taxes, and regulation, or have we been fighting taxes, energy, and regulation for my entire lifetime? I mean, every election I think of, it's always this battle, and they fight back and forth. While we may get some, a few years of a good policy, it just gets erased with the next administration, and it goes back and forth. So unfortunately, we have this bickering, which I don't think will ever get general consensus. So I don't think we'll get back to that amicable state where everyone agrees, hey, yes, we all agree on energy, we all agree on taxes, we all agree on regulation. If we got to that point, we'd probably be in a much better place. Unfortunately, I think that these people like to stay in office by disagreeing with each other and not really helping out the cause. So while I like that one, Tom, I just don't think it's going to happen. I don't think they're going to reduce it. Remember, they've got the money in circulation now. Pulling it out is a much more difficult challenge. Okay, so there's the triple Qs. You saw it just continue to rip to the upside today. I should probably redo our calculations because based off our calculations, the all-time high for the S&P is only 1.9%, not 6% as I pointed out yesterday. And that's because the futures contracts were skewed. There's an adjustment setting that was checked, and I don't usually check that setting personally. I leave that one off, and I'll show you here in just a second. So NASDAQ 100 today, a 1.27% move to the upside. Your all-time high right there. Let's go back to, that's going to be November 21st. The triple Qs, I'm going to do this percentage thing off the triple Qs just because I think it's going to be a much easier way for us to get the actual number. 408.71 is that all-time high that you see going back into 2021. I can roll out here so you can see the other peaks, but clearly it's 2021 is that peak there. From current levels, it's actually very close, a lot closer than I calculated on yesterday's show. Yeah, I think it's pretty safe to say we will beat all-time highs by the end of the year on the NASDAQ. It's only 1.13%. Now, one thing to keep in mind, one of my mentors always talked about the blue sky theory. It's just a guy I traded with, and he was an interesting dude. He always called it the blue sky theory. He says, when something breaks into uncharted territory, when you pop through a ceiling of price and there's nothing above you to stop it, what do you think happens? What do you guys think would happen if we break through the ceiling on the triple Qs? And you look off to the left and there's nothing there. All right, what is it? 1080p, I know I'm running 720. The reason I didn't do 1080 is it has issues with the streaming. Are you thinking time or close to time or short Qs? Are you thinking time or close to time? No. So Lisa, it's a good point because I like shorting things when they come into overhead supply, right? And you notice that we are coming into overhead supply. Let me switch this up to a weekly because it makes it a little bit clearer and I don't have to keep scrolling in and out on you guys. There you go. So if you look at the weekly time frame, I mean, we are technically up in that area of supply. The peak, the all-time high is only 1.13% away. Keep in mind, we moved 1.27% today. So we could easily hit that tomorrow, break through the all-time high. Now, normally, I would say if we're coming into supply zone shorted, I am not saying that now. And the reason for that, Lisa, is I think that there's a magnetism to this right now. I believe that because everyone is thinking all-time highs, and take a step back and just look at how you guys are thinking. You're probably watching other media sites, you're looking at the news, maybe Fox, Bloomberg, CNBC, and the topic of discussion is organically all-time highs for the market. Why? Because we're so close. So it's kind of like a Ouija board. I don't know if anybody ever did a Ouija board when they were younger. But, you all put your hands in that little spade-shaped, looking glass thing, and you spell out different words. What happens is you subconsciously push that device over the letters that you want to see. And I don't think that that's any different than what we have going on with our markets right now. I do think that you're going to see it break the all-time. When we looked at 6.9%, I thought that was unreasonable, and that's why it seemed so strange to me on yesterday's show. But based off 1.13%, yeah, easy, no problem. No problem breaking the all-time highs, and that may actually lead to a much bigger surge in our equity indexes going forward, because blue sky theory is when you pop through these levels and there's nothing to look at, it's going to really just keep on going. So I have to say I would almost put myself in the extremely bullish category. I don't usually like to go extremely bullish, but we're right about there. I think the markets are just psychologically pushing it to the all-time highs. It'll probably break through. We might get a small pullback, but most likely we'll just keep on ripping through that one and go to all-time highs. So crazy potential move up here for our markets. Now I'm going to keep it on a weekly time frame and go up the ladder here a little bit, and I will go to crude oil. Crude oil, 1.25%. What is going on here? There we go. Go to our daily. All right, 1.25% move up for crude oil. Again, I still do think you'll come down and challenge this $67 line. We got pretty close to it today on that futures. We hit an intraday low today of 67.71, so right about 71 cents away from that demand zone, or at least that lower level here, which would be right around this basing area that we see going back to March, April, May, June, and July. Buy calls on SPY and QQQ. Well, remember, if you're buying calls on those indexes right now, you're paying a premium because right now that's all people want. Calls are expensive. Puts are cheap, right? Puts are cheap. Blue ocean theory, yeah, blue sky above you. Maybe blue ocean below you if you're hitting all-time lows. But yeah, it's blue sky theory. All right, so that's your NASDAQ. And again, based off that chart, you look at the NASDAQ 100. I adjusted it. So let me show you guys an example here of adjusted versus unadjusted charts. I know most of you know this. I don't know how this got adjusted. I know when I made this purchase, I bought the updated package. This was set, and my numbers have been wonky ever since. So you'll notice if we go back here, this all-time high on the NASDAQ futures is right here, right there. So that's 16,767. If we adjust it, which means take into consideration the rollovers and the gaps that happen on futures and adjust for that, all of a sudden it makes it look like that previous all-time high is 17,700. Completely distorts the chart. And the further back you look, the more that data is out of line. Now, how do I know this to be true? Well, remember, when I was on CNBC back in the late 90s, in 2007 and 8, I was looking at the S&P 500, and I said when I was on TV, I said if we break 1260 on the S&P 500, break out the bulldozers, we're going down in a big way. I was like, okay, why? Well, because if you take 1576, which was the all-time high of the S&P 500 at that point, and you take 20% of that, remember, bull market is 20% off the highs, that's 1256. So let me go look at the S&P 500 here real quick, and we'll go back on a weekly time frame just so you can see the math. All right, that was way back here. It was so long ago. Okay, so here is the 1576. I'll put a horizontal line right about there. It's slightly off. It was 1576, but it's showing 1586. If I use that on unadjusted, that level will stay pretty much the same. But if I click this, I'm sorry. I'm over here just watching you guys watching me rub my mustache. There's your 1586. For me, it was 1576, but that's the number that's coming up. Watch how big that number changes, how much it changes if I adjust this. All of a sudden, what? It's not doing a dang thing. That's so weird. Huh. I'm going to adjust it again. That's weird. It's staying the same. It usually throws it off. The longer that you go, the more dramatic the difference is on an adjusted versus unadjusted chart. I'm not sure why that's happening. But you can see here just on this information, this is what we looked at yesterday. And it was at 5,028. And when I finished the show, I'm like, the SPX hasn't been above 49. I'm like, wait a minute, what happened? So I went and looked, and it's just this adjustment was set. And if I click on that high right here, now you're looking about 48.08. Yeah. And this is the thing, Lisa, on every platform, it's different. On every platform, it's going to be different. So with TradeStation, there was a specific formula you typed in on every time you pulled up a future symbol. It's like Y equals MX plus B. It's this really weird formula. But 108XN was the number. That's the number you would type in to get rid of all of the adjustments. And this way, I prefer unadjusted charts. Right? If you click on this, it adjusts it, and the numbers shift dramatically, and all of a sudden, my data is wrong. So I don't know why that happened. Chad, good eye for catching that one yesterday, but I noticed it as well. Typically, I'm using unadjusted charts, and I recommend you guys do the same. It's better to keep your numbers stay the same, whereas they would shift if you use the adjustment and turn this one on. So not sure why this popped up or how it got selected yesterday, but there you go. All right, let's go crude oil. So here's crude oil weekly chart. We'll go to a daily time frame. You got that one there. Again, we talked about this already from an inflation perspective. This has been the big piece. We had our PPI numbers come out today, and if you look at the PPI data, here's a table of it for you guys. The only one that really showed improvement is energy. Everything else is kind of staying the same. Slight increases. Notice that foods, month of November, like big surge up in food prices. And it's kind of annoying. That it make us feel like everything's not changing. The reason that we're seeing inflation stay the same and not increase is because energy has dropped so much. We talked about that yesterday, but food prices are significantly increasing, right? If you look at September, it's 0.6% increase. October showed a contraction of 0.1%. November, a gain of 0.6. I mean, these are big percentage increases. If you analyze 0.6 times 12, you're looking at about 7.2% inflation. Thank you, Tom. You went from the slope intercept formula. Y equals MX plus B. Going back to my old algebra days. It's really funny. They teach that stuff in high school, and we know that. Like, most people are like, oh, yeah, I know Y equals MX plus B, or A squared, B squared, C squared, Pythagorean theorem. Yet, let's tell you how to balance your checkbook or how fractional reserve banking works, and people are like, huh? What are you talking about? Teach people the important stuff. I'm never going to use Y equals MX plus B. Like, I'm never going to use that calculation. Now, I worked for construction for a little while. I love geometry, angle, sine, cosine, tangent, right angles, acute, obtuse triangles. All that stuff is awesome, really important. I don't know. I'm sure all my algebra geeks out there are going to be all upset at me now that I'm insulting the Y equals MX plus B formula. All right, so let me keep going up my list here, and then we'll wrap this thing up. I got a bunch of stuff I got to take care of today. I got a class coming up tonight for OTA as well. We already mentioned that S&P 500. If we go back to those numbers, and we got the unadjusted ones here. We'll go back to that peak. It's right there, 48.08, and you look at where we currently are. Guys, we are ridiculously close to all-time highs. I mean, yesterday when we did the show, we were technically just about 2.35% away. Well, now we're under 1% away from all-time highs. So, yeah, I think we're going to hit it. I apologize for my data issues yesterday. I'm not sure why that happened. I do remember Blue Sky Airways. Greed is good. Greed is right. Greed works, right? Famous line from the movie Wall Street. Blue Sky. Blue Sky Airlines. All right, so that was your S&P. Here is your Bitcoin price chart, recouping a lot of the losses we saw on Monday's session. Remember, Monday was just a brutal down day, just crazy. Today, regaining a lot of that up, 4.23%. I actually thought we might come a little bit lower and go towards this moving average on the Bollinger Bands here. That would get us down to right around 40,000. But today, nice pop to the upside. So all in all, looking pretty dang good for Bitcoin. I'll take the Bollinger Bands off because I don't normally use them. And lastly, let me look at IWM here. That the Russell 2000, I'm going to bring up your intraday. I mean, this thing just was unbelievable today. We went from 185.60 to 194. So from low to high, from right as that FOMC announcement happened to its peak, you're talking a 4.5% rally for the IWM on the day. Pretty amazing move. Yeah, I'm regretting the fact that I got out of some IWM. That's for dang sure. Is what it is. We'll look at that daily time frame here again. I don't know why my boxes are gone. Oh, that's right. I only had them on the futures. So here's your futures chart of that. And let me take that off. we are still within that, but had a beautiful, just strong move up today, breakout. I would have expected it to stop right around 1923, but it did not. Went through that thing like a hot knife through butter and just keep on ripping. Ultimately, I think you're going to be, based off this, you're challenging that 2025 level coming up here soon. What I will say is I do not think in any way that the Russell will hit an all-time high this year. I know that's not going to happen. I'll take anybody's... I don't know, not anybody's wager. I mean, remember, the all-time high is how much further away? Let's get to that exact level. If you go to the high from 2020, maybe. Hold on here. Yeah, it's right about there. And if I take from current price, okay, yeah, it's only 2.09%. Never mind, I'll shut up now. All these index could hit highs for the years. All of them. Jeez Louise. Who knew? Who knew? Actually, I can tell you who knew. Right, there are some of you who absolutely knew and you had thoughts on this one, and I think I actually have that list here somewhere. I'll go to my daily materials, and I think I actually have it set for 2023. Where was that one? I don't know where my expectations are for that, but I'll show you guys that one at the end of the year when we look at the actual numbers of forecasts for the S&P 500 for the year. I remember I had that one written out somewhere, and I will do my best to show that to you guys. Not today because I can't seem to find it, but I will certainly show you when we wrap up our yearly. Oh, here it is, our yearly forecast. Let's see. Just curious, we're getting now the last couple weeks. Let's see who is actually winning this one. I will put the spreadsheet over here. I will share that with you guys, and here it is. All right, here's my spreadsheet. Right now, we're going to go to the S&P futures, trading at 47.60. Oh, man. Here's our whole list. The vast majority. We are currently sitting right here. Ed, up in San Jose, you're close. You're real close. I'm going to put a little line right there and zoom in. 47.60. It looks like Alex Nader, who I don't see watching the show much anymore. Only a few of you. Mike LaRusso, Ben, Believable Direction, Tob Elms, Alex Nader, and are the only ones that have it higher than current price. Yeah, can I change my numbers, Lisa? Absolutely not. Well, and this is, let's see. Lisa, you had 41.20. Don't feel bad. I was at 39.10. I'm pretty sure I'm not going to get my number. It'd have to fall like 20% from current levels for me to get my number. So way off. I was right the first 2 quarters, not right. Actually, the first quarter, I've been wrong overall for the year. Of course, there's always Anna D'Souza, which said she thought the S&P was going to be at 1574. So there's wrong, and then there's, holy cow, what were you thinking? The beauty of trading and investing. All right, there we go. Let me get back to that. We already talked about the overall markets. We talked about bonds. We talked about the dollar. We talked about pretty much everything. For tomorrow, you do have some big earnings. Of course, we have Costco. We're reporting earnings tomorrow. You also have Lennar, which I think is going to be an important one. Let's just go look at those 2 charts here to see what Costco has been doing. I am bullish on Costco, and man, it has had a ripping run going back into that late October. I know the indexes have been up significantly, but if you go from where this rally started for Costco to where it ended right now, it's up 18% in the last 32 trading sessions. So great move up for Costco. You zoom out and you look at it and go, oh, it's at all-time highs. Blue sky theory. Here we go. Could keep on going and going and going. Costco, and then you have Lennar. Home builders been of interest to me. I'm really surprised to see how much they've surged over the past month and a half, as everything in the broad market has. I think a lot of that has to do with expectations about rates going forward. So those are your 2 major companies coming out with earnings. And as we talked about for your economic calendar, let's just go back here and go to our current dates. Let me get all these out of here, remove the filters, and we will go and look at current market date, which is, right? Come on. Where is it? Give me my December. There we go. December 14th. You have tomorrow a huge bevy of currency rate announcements. You have the Swiss National Bank coming out at just after midnight Pacific time. You have the Bank of England coming out at 4 a.m. Pacific time. You also have the EU coming out with their main refinance rate, all of which are expected to stay right where they're at. And then when the U.S. markets open, once we digest those moves, you have retail sales, unemployment claims. You also have import prices, natural gas storage, business inventories, a lot of stuff happening for their earnings for our markets for tomorrow. As Jay Patel says, Adobe crashed post earnings. Yeah, they actually beat earnings today and got smoked. They beat earnings and were down like 6% when last time I checked. ADBE. they're down only 4.76% now. Okay, in the after hours. So yeah, Adobe taking on the chin in the after hours session. But honestly, look at that chart. This in October of this year was at 270, or last year was 274. It deserves a pullback in my opinion. Definitely deserves a pullback. Let's see what else we got. What Tom B put on that again? What? You were not on there. Where's Tom B? You were at 46.48. Oh yeah, they're just slightly out of. Yeah, you were at 46.48, Tom. I got you right there. You're close. Close, but no cigar. I have a feeling based off this, it's going to be Alex. We'll see. I think we'll get above that 4,800 mark. We'll see. Exactly, Big Ab. Small pullback on the bigger picture, right? Adobe up 80% year to date, but yeah, we'll take a 5% pullback. You know, buy the rumor, sell the news. Typical. All right, that's going to do it for me for today, everybody. I'm going to wrap this thing up. I got some stuff I got to take care of, and I got a presentation starting at 4 p.m., so I will be busy tonight. Tomorrow, I think I've got an in-center Irvine event going on. I'm going to be doing a presentation for Irvine, I think, from somewhere between 6 and 8 p.m. Yeah, I think that's pretty much my schedule. And then we'll be doing the show tomorrow. I did reach out to Bill Addis because I want to get him on here to see what he thinks about this, the current announcements and the changes that Jerome Powell and the FOMC have made with regards to what they're saying in that statement. Yes, that's right, Sam. Absolutely. You know, I can look. You guys want to look at a chart? Oh yeah, here's right where this is exactly where he bought, and he'll probably show you a chart that showed that he called this level down here at the bottom, way down here at the bottom. Now, that's where I bought. Yeah, that's where I bought. I bought this stock here. See, I bought it. It's the best time to buy. I'm the greatest trader ever. All I do is call levels, and here's I'm gonna sell when it gets up to here, and if it gets through here, then I'll just cancel my line and pretend that I sold it at a higher price because I'm such an amazing trader. Yeah, I love clowns like that. Draw a bunch of lines and then erase the ones that don't mean anything and don't take credit for anything. Yeah, well, there you go. Some of us make mistakes like I did yesterday on our show. All right, I don't own Adobe, just so you know. Sorry, I have good big. Lisa, was that to me? Okay, that was good. There we go. I wonder if the winner is single. Maybe they'll take you or me on a cruise with them. Hey, I'm gonna win the lottery to take you all on a cruise. That was the breakdown. All right, that'll do it for me, guys. Tomorrow, Costco will be the fun one to watch. That's going to happen after hours, so keep your eye on Costco and Lennar aftermarket. You obviously have your retail sales and a lot of central banks to keep an eye on for tomorrow. So thank you so much. If you have anything you want me to talk about, I didn't get too many emails other than from Chad. Chad, thank you. You were right on with some of those assessments. You can email me at the email on your screen, which is TraderMerlin@gmail.com, or comment down below any of the videos. I always look at those and usually incorporate those in. Have a fantastic remainder of your day, everybody. I will see you tomorrow. Take care.